So everybody feels good, right? I hope so. Those first two statements aren't that challenging. The balance sheet is a little bit more challenging. It's just not quite as intuitive. You could probably teach a fifth or sixth grader the income statement and the cash flow statement, and most of them would pick up on it in a relatively short amount of time. The balance sheet's a little different. The balance sheet is associated with a practice called double entry accounting. And the idea is that we always want to keep the balance sheet balanced. That's why it's called the balance sheet. The balance sheet must be in balance. If the balance sheet is not in balance, it's not a sign, it's not a bad sign for your company, it's a bad sign for your accounting practices. So the only reason that the balance sheet wouldn't be in balance is if, and you did everything right, is if, either somebody stole money or, you stole money from somebody else so that your cash on hand, your asset, or you stole something so that your assets look better, are better on your balance sheet than they actually are. What the balance sheet says is that everything that we own, everything in the company must be paid for. We have to pay for all assets in one of two ways, either by borrowing money through debt, that's our liability, or through owner's equity. So that's money that we individually invest, or outside investors or partners or family members or whoever invest. All right. Basically, everything we have, the assets, have to be paid for. A equals L plus E. Assets equal liability plus equity, or assets equal debt plus owner's equity. Go ahead and click on that link, or copy and paste that link into your browser and watch the video from 1116 to 1503. This is a balance sheet in Word form. So if we lined up everything that the company owns and took a picture of them, we could take a picture of all of our assets. All right, so on this slide, we've got assets on the left, just like you would have on a balance sheet when you actually listed them and wrote down the dollar amount. Some types of assets are current assets. These are assets that have a lot of liquidity, that are quickly converted into cash, that you can move quickly. So you want to keep up with those separately in a category called current assets. We're going to use current assets in a future use to try to measure the liquidity of the company and the financial health of the company. So current assets are cash, accounts receivable, and inventory. Fixed assets, these are long-term assets that aren't easy to move. So things like machinery and equipment, buildings, land, those are fixed assets. And then there may be some other kind of catch-all categories. So long-term investments that are kind of outside the scope of operations, patents would fit here. These are things that don't really fit in the current and fixed category very well. You may or may not have a category for these additional assets, all right? And all of those combined are going to equal to my total assets, all right? Total assets have to equal everything on the right. So everything that I own has to be paid for. There's two ways to pay for things: debt or liabilities, and owner's equity, all right? So debt is things like accounts payable. I've got to pay off my accounts payable, right? So, I bought some inventory. I'm seeing that on the assets side. How do I pay for that? Well, I might have paid for it with cash, in which case the cash position would go down. But in this case, I'm saying, accounts payable is a thing here. So that's debt that I've got to pay off. Accrued expenses, I talked about this earlier on the income statement, but this is just the idea that the things that we have wear out and we want to keep up with that, right? So the value of my buildings may be less at the beginning of 2021 than they were at the beginning of 2020 because of wear and tear, all right? So I made that number go down a little bit. How do I keep up with that? Well, I put in my accrued expenses here. All right. Short-term notes, these are short-term loans that I have from the bank, maybe a short-term line of credit. All right, so that's short-term debt. And then I've got long-term debt as well. So I want to keep up with those two things separately. Later, I'm going to compare current assets to current debt for my current ratio, which is an important measure of liquidity. All right, my long-term debt is going to be things like long-term notes that I'm going to take more than a year to pay back, as well as the mortgage. So, anytime I buy a building or a piece of land, it's easy to get a loan for those things because the bank can come in and just take those things if you don't make your payment. And so that's a long-term debt. I cannot move that easily. All right, and then I've got owner's equity. So that's going to include things like what I put in the business to start it up, or what a partner put in the business, or if I've got outside stock owners, what they put in the business. So what all of the owners have invested into the business. All right, so we add up our debt and our equity, and that equals total debt and equity. And that, of course, is going to be equal to the left-hand side, the total assets. Here is an example of a balance sheet. I've got Teddy Fab again from the year 2100. And just take a look at all of those categories. I've got my current assets. They total to be $149,000. I've got my property and equipment. I've got my other assets. Add everything together. My business, the value of my business in terms of the hard assets is $472,100. And then on the right-hand side, how do I pay for that? It looks like $247,000 of that was financed through debt, and the remainder of that, about $225,000, is financed through equity. All right. Now, a lot of that equity is retained earnings, right? So when you make profit and you don't pay yourself and you keep that in the business, that's retained earnings. That's equity financing, right? So when you generate sales and make profit and cash is coming in, money's coming in, income's coming into your business, you can keep it in the business in terms of shareholder equity and use it to pay for other things, all right? So if you don't do anything with it, it just turns into cash, right? Because it's in your bank account. Or you can convert it into inventory, investments, equipment, whatever, all right? Basically, that's a big source of financing for a lot of businesses, for most businesses. So that, it's not rare to see a big number like that $197,100 total there on the right. If you look at all of the different categories, that's one of the biggest on top of long-term debt, besides long-term debt. So that's a common way of financing your assets in your business. Okay, I want us to work through an example. All right, so this is the example of two children, and they decide to start a lemonade stand. And they have $10 to invest in the company. All right, so we've got our balance sheet equation written here at the top. This equation is going to change as the business changes, as the business grows, as transactions are made. The different categories on the balance sheet change. And I want you to see how this works so you can get a good idea of double entry accounting. All right, so the children start a lemonade stand. They invest $10 in the company. So at the beginning, the equation looks like this. All right, $10 in cash equals liabilities of $0 plus equity of $10. That $10 is in equity because it was the investment of the owners, the children. All right, after thinking about what they would need, they realized they needed a lot. They requested a loan from their mother, and their mom gave them a loan of $40. So now they have $50 in cash and two sources of financing: the $40 loan from mom in liabilities and the $10 in owner's equity that they provided. All right. In preparing for their opening day, the girls bought $40 of premium pink lemonade mix and paper cups. This represents their inventory. They're going to convert all of that into cups of lemonade. So they have the cups, they have the mix, the water is taken as free here. After that, you may want to pause the video for a moment and think about what the balance sheet is going to look like, or you can, just kind of watch it straight through as I go through, and then go back and watch it again and pause and think about it. I do want you to understand the mechanics of this. All right, so now we've got assets kind of changing form. We did have $50 in cash, but now cash goes down by $40 and inventory goes up by $40. The right-hand side of the equation, the liabilities and equity don't change. All right, this is still double entry accounting. It's just that both entries occurred on the left-hand side. Cash went down 40, inventory went up 40. All right. Here's what happened once they got there. The girls allowed customers to pay with either cash or credit. By the end of the day, they had sold 60 cups at $1 each. 30 cups that were bought on credit, 30 of the cups were bought with cash. All right. Since the lemonade cost the girls 25 cents a cup to make, they made 75 cents per cup in profit. All right, so they're just telling you that. All right, for a total profit of $45. How do we get that $45? Well, they sold 60 cups of lemonade and they made 75 cents of profit each. And so if you get out your calculator, if you can do the mental math and you multiply 60 times 0.75, that's going to be $45 in profit. All right. All right, so after all of these transactions, this is what the balance sheet looks like. Let's talk about each of these numbers. All right. Ideally, you would be able to take what I gave you in this third line, the $10 in cash plus $40 in inventory, and after I tell you about the transactions they make, you'll be able to generate this fourth line. That's what you should be able to do as a small business owner. And if you can do that, you're ready to do the accounting that it takes to be a small business owner, okay? If you have an understanding of what just happened here, you've got the basics down of the balance sheet. All right, let's walk through it. $10 in cash turned into $40 in cash. Well, how did that happen? It happened because they sold 60 cups of lemonade for $1 each, but only 30 of those cups were sold for cash. And so I know there's like tons of information coming at you fast, but what I said was they sold 30 of the cups for cash and 30 of the cups for credit. And so the cash position went up by 30 bucks to $40. All right, they've also got $30 in accounts receivable. Where did that come from? And what's an account receivable? Well, you know what an account receivable is. It's a receivable that you will receive at a later date because you made a sale, right? It's future revenue that you've already spoken for, you've already claimed with your sales. And it's actually, I shouldn't say it's future revenue, it's current revenue, but it's not in the form of cash yet. All right, so 30 cups of lemonade were sold on credit. That's $30 of accounts receivable. All right, now $25 in inventory. How did I come up with that? This one requires a little bit of thought, but if you recall, they sold the lemonade for $1 per cup, and we made the point that they made 75 cents of profit for every cup of lemonade. That means that their inventory went down by 25 cents a cup, right? Basically, they put 25 cents into each of the cups of lemonade, right? They had they sold the cup for $1, they made 75 cents profit, 25 cents of inventory per cup disappeared. All right, we know that they sold 60 cups of lemonade, so now we just do 60 times 0.25, right? 60 times a quarter per cup, and that's gonna, you do the math on that, and 60 times 0.25 equals $15. So basically, they used up $15 of their inventory. All right, so my inventory position went down from $40 of inventory. Now, you know, the bag of stuff I took home was lighter than what I brought to the park. I got rid of some cups, I got rid of some lemonade, and I've got $25 of inventory rather than $40 of inventory. All right, so that is the left-hand side of the equation. The total value of the left-hand side of the equation is now $95. If I put a value on all the assets in the company, it's a $95 company. All right. On the right-hand side of the equation, there's not as much change. I've got my $40 original loan from mom, and I've got my $10 original investment plus the $45 in retained profit. And I told you that there was $45 in retained profit. I actually, just directly told you that. But you could have calculated that if you would have known how many cups I sold. Since you knew I sold 60 cups and there were 75 worth, I made 75 cents of profit each. My $45 in profit is there, 60 times 0.75 again. All right. So that's what their balance sheet looks like. When one of the girls looked at the balance sheet, she questioned why cash would only increase $30 even though profits were $45. Why aren't they the same? All right. What do you think? Pause the video and think about that for a second. Why is my retained earnings less than my cash? Well, retained earnings come from two places, right? They come from receivables and cash. And my total increase in receivables and cash on the left-hand side was $60, but my retained earnings aren't $60, are they? So what we have to learn from this is that cash and profit are two different things, right? I brought in $60 worth of worth of cash and accounts receivable. $30 of that was cash, and I made $45 of profit. Not all of the money that I got that brought in I can count as profit, right? A lot of it was just to pay myself back for buying that inventory, right? So if I hadn't sold that, it would be a net loss to get that part. And then the $45 on top of that, that's the retained profit. All right. Now, wanting to let their, so I'm moving to the next stage, wanting to let their accounts receivable, not wanting to let their accounts receivable go uncollected for too long, the girls hired their younger sister for $5, and she was to either email or call their customers in order to collect. Happily, maybe a little surprisingly, she was able to collect all the money that they were owed. With the money they collected, here is what the balance sheet looks like now. All right, my cash is now $65. Why is that? Well, she collected the $30 that we got that were in accounts receivable, so we get to show that now. But we had to pay her $5, right? That was the cost of doing business, and so our cash position doesn't go all the way up to 70; it just goes to 65. All right. We erased that $0 in accounts receivable. Yay! All of our customers paid up. We still have the $25 in inventory. We didn't sell any additional lemonade. We didn't get rid of any cups. All right. On the right-hand side, we still have our $40 loan from Mom. The equity, though, is now our $10 initial investment plus $40 in retained profits. If you'll notice, the retained profits went down, even though we're in a happier place, right? Because we changed those accounts receivable into cash. Our retained profits went down because we had to pay out $5 to the sister. So here's a case where our balance sheet decreases. Our total profit, our income statement, that if we did an income statement along with this, that would decrease. But we're in a happier place, right? We did this on purpose. We're better off because we collected that cash. And so, the sisters were glad that the younger sister was able to do the job. Seems like something that you would have your older sister do, but in this problem, it's a younger sister. Okay, next step. For the next week, remember they've got this inventory, so they're going to go out there again and try to sell some more lemonade. The girls decided to expand the operation. They hired 2 friends and agreed to pay each $10 a day. This allowed them to expand their business operation to 3 different stands. So I guess the girls worked on one stand together, and then each of the friends did another stand. Not liking the hassle of collection, they chose not to sell on credit this time. By noon, they were wiped out. They had sold 100 cups of lemonade, depleting their entire inventory. After paying their friends $10 each, the girls were delighted to see that they had made $50 more in profit. So the balance sheet at the end of the day appears like this. We now have $145 in cash. How did we get that? How did we increase our cash position? Well, we sold 100 cups of lemonade. That's a lot of lemonade. And we also had to pay off our friends $10 each, right? So we went from 65 to 165 and then back down by 20 to 145. All right. We didn't do accounts receivable. We don't have to worry about that. That number remains 0. Now we have $0 in inventory. And we can, if we think about it and we put pencil to paper, we can account for that $0 in inventory. We know it's 0 because we were wiped out. We're out of cups. We're out of mix. We don't have anything else to sell. Back to the drawing board. But we could also calculate that mathematically. We know that they sold 100 more cups of lemonade and that each cup had 25 cents in it, right? 25 cents of lemonade and the cup, the cup's value and the lemonade's value. So we go 100 times 0.25, there's our $25. So we had $25 in inventory before, we used it all up, now there are $0 in inventory. All right, so everything on our left-hand side of the equation is now in cash. That's nice. On the right-hand side, we've got the $40 loan from Mom. We understand where that came from. We've got the $10 original investment. We understand where that came from. And we have $95 in retained profit. Now, where did that come from? We had $40 in retained profits before. How do we calculate the $95? Maybe pause the video and think about that one. So how do you get that? Well, first of all, we know that our profitability on each cup of lemonade is 75 cents, right? And so we sold 100 cups of lemonade. 100 times 0.75 is $75 of profit, all right? So we add 75 to 40 to 70. We add 75 plus 40, and now we're at $115. That's what it would be, right, if we didn't hire our two friends. But because we did, and we already took that $20 out on cash, we've also got to take it out on the right-hand side as well, right? We would have, if we hadn't hired the two friends and done it all ourselves, we would have made $165. Would have had $165 in cash. Because we hired them, we've only got $145. That extra $20 has to be accounted from somewhere. So rather than having $115 in retained profits, which is what we would have had if we would have done it ourselves, right, and sold all 100 cups ourselves and made that 75 cents and got to retain it all. No, because we paid our friends $10 each, that $75 goes down to $55 because we paid two friends $10 each. And so we add $55 to the original $40, and we have $95 in retained profits. All right, now finally they pay their mom back the $40 in cash they owe her, and now our cash position is down to $105. All right, we've got $0 in liability, don't have any more debts. We've got our $10 original investment and our $95 in retained profits. 105 in cash for our assets equals 105 for our liabilities and equity. And if you go through and check, because we did our accounting right, the left-hand side of the equation is always equal to the right-hand side of our equation. If at any time it hadn't equaled each other, a lot of students think if the balance sheet doesn't equal, then the business is unhealthy. No, if the balance sheet doesn't equal, you did something wrong with your math, all right? So the balance sheet should always equal. You can have an unhealthy business where the balance sheet is equal. In fact, all unhealthy businesses where the accounting is done correctly, the balance sheet equals. The balance sheet being in balance is just a sign that you've done things right from an accounting perspective. Here are some very basic questions to check yourself to make sure that you understand the basic concepts of these accounting statements that I've been going over. Okay, so if you can't answer some of these questions, then really when it comes to accounting, you're not on first base yet, and you're not ready to go further and actually start looking at the numbers and using the numbers to do things. You've got to be able to understand the inner logic behind these three statements, why it's important to keep up with all three of those. So that includes, understanding the purpose, really understanding the purpose, not just being able to parrot back some words, but understanding Why it's important for a company to do all three. We want to know how profitable we are. After all, the name of the game is profit, and if there's no profit, there's no reason to start the business. So there's the income statement. We have to stay cash positive, and so we have to, keep the lights on. We have to pay our bills as they come due. And so it's really important to keep up with cash, with our cash flow statement. All right. The balance statement, basically the idea is that we have to pay for long term everything in the business, right? And we need to monitor the size and growth of the business. There's lots of purposes of the balance sheet. It's very versatile. But we want to keep track with our assets and our sources of financing and our amounts of financing. And so the balance sheet gives us a snapshot of the business as a whole, and it's really a very valuable accounting statement. All right, so those are the main purposes. So, you should really have a handle on those. If you can't answer one of those questions, contact me. Let's talk about it. We need to figure out where your knowledge gap is, and I will try to help you fix that.